Good afternoon. Time to check in on those markets. We're going to have a look at what's happening on the Asian side of things. We did see the Hang Seng Index closing lower by 2.7%. And this is on the back of reports that Chinese authorities imposed a fine on Alibaba and Tencent. This was as a result of them not complying with anti-monopoly regulations, especially when it comes to the disclosure of transactions. We also saw China a little bit lower, those COVID concerns growing increasingly high as Shanghai reportedly discovered a new Omicron subvariant. So various investors watching to see if a sense of normality might actually come back to the fore, especially when we look at China and that hard stance that they had on the COVID regulations and also trying to keep everything intact. And as a result, we're also seeing some of the hotel stocks in the Hong Kong side closing lower. And this is after Hong Kong said that the city of Macau will be closing most businesses as they try to rein in those surging numbers. However, what we're keeping an eye on, in particular, what I'm focusing on, will be on the rand. As you can see, the chart behind me indicating where we're currently sitting around 16.99, oscillating between 16.98 and 16.99 at this particular point. That 16.99 level, we haven't seen it since December 2020. We've seen the dollar index strengthening a little bit higher, and of course the dollar strengthening 24-year high against the yen, 20-year high against the euro. And when we look at what's happening from a euro perspective, that's because investors are concerned that the ECB is behind the curve when it comes to the Fed. We are seeing that policy divergence, but the ECB has, I suppose, call it a tougher stance in the sense that it's a fine line to play between trying to raise rates and also not slow the economy down with the Russia-Ukraine tensions and the concern around increasing gas prices, possibly fueling even higher inflation. Nonetheless, we are watching what is happening with the rand, and it was quite interesting. A little bit earlier on, probably 10 days ago, it was around 1680. Now, actually, as you look back on a 3-month basis, around 1450, which is what we were looking at when we were talking about the rand around about March, April. But some commentators have said that the rand has been pushed higher as a result of that stage 6 load shedding. However, there were other global factors that have been pushing the rand to the levels we're currently seeing. And that, of course, is that higher dollar index as investors flock to seeing the dollar as a safe haven asset. Now, to talk to us about the latest dynamics that we are seeing in the market, we are joined by Bright Khumalo, who, of course, is from Vestec Asset Management. Bright, thank you so much for your time. Checking in on the JSE. We're a little bit lower, seeing red on my screen. How are we doing now, and what's driving those red numbers?
Yeah, looking at the JSE, I think we're down about 1.1%. It's mostly a resources story, which is, the resources 10 index is down 2.9%, with names like Kumba, Impala, and Anglo all down between 6% and 4%. So it's not looking good on that side. But surprisingly enough, there are some companies in the green, Mediclinic being one of them, Shoprite up 1.2%, and Anheuser-Busch InBev finally knowing what it's like to have green next to their name.
So I can imagine we're going to be seeing another sort of sense of volatility as we have U.S. inflation figures on Wednesday ahead of earnings season, which kicks off on Thursday. I mean, what are the markets anticipating, especially when it comes to that U.S. inflation figure?
Look, so inflation, it's a story of is it accelerating or it's cooling off, and obviously depending on where the numbers come, we might see a relief rally if they're showing signs of cooling off. But the sort of the market sentiment is that inflation will be persistent, and as a result the market will be a little bit weaker. But everything remains to be seen until we actually see those actual figures come out on Wednesday, like you were saying. But I mean, looking at the earnings side of things, all eyes on tech, especially since they re-rated lower. We recently had a nice 2-week rally, which the Nasdaq is now no longer down 30%, but down about 18%. year to date. Let's see if we can sustain these types of this type of rally during earnings season. But the narrative there with stocks, the question is whether we'll see this re-rating go further downwards for tech, and if yes, maybe we might see a bit of weakness there in tech stocks.
We'll come back to the earnings side of things, but let's focus in on tech there. I'm curious about the investor mood when it comes to the Chinese tech sector, especially when you read reports that the Chinese authorities imposed a fine on Alibaba and Tencent.
Yeah, I mean, technically speaking, the only people who can invest in Chinese, especially in Shanghai or mainland China, as they call it, are people of Chinese descent, meaning you were born and bred in China. So if you invested in Chinese stocks and you're seeing flames, it's part of the game, I guess, because you invested through the Cayman Islands. But looking at that market, that sector itself, especially tech, up about 28% year to date. The last time I checked, it's been the green shoots that everyone's been talking about, but it's because of many different reasons, including looser monetary policy and the government doing all its best to actually aid that market. And this is sort of a very different stance that you're seeing from the West. This is Southeast Asia, obviously, but yeah, it's very different from what we're seeing in the West, US, and Europe as well. So hence that market is up quite a lot year to date, and we're seeing that translate obviously to Naspers process here locally.
You were talking a little bit earlier about U.S. earnings, and some analysts saying that earnings season could be the next key test, especially when you're trying to see, at least from the retailer side, the consumer sentiment and whether consumers are cutting down on spending. What else will you be paying attention to, especially as those earnings reports keep coming in? We're going to kick off with the banks as usual.
Yeah, I mean, looking at the recent data that came out on Friday, we saw that 372,000 new jobs were created, and those people are going to be earning real income, right? And I don't see the consumer sort of spending less in the US, meaning those retail stocks, even though they were dwindling in terms of earnings, it won't be a bad print that we're going to see from the retailers. And also in the last set of quarterly numbers, it was a very mixed bag, with things like Walmart seeing some flames, while other retailers were sort of, specialty retailers. Those tended to do quite well, and they were holding up quite nicely, and the share prices reacted accordingly. But looking at the kickoff, which is tomorrow, I'm not watching anything particularly tomorrow, but it's going to start be interesting, on Wednesday, like you say, with banks. We used to hold JP Morgan. We're sort of getting out of that one very slowly, but the story there was that, interest rates are going to be good for these banks, but unfortunately, most of the big banks in the US are, transaction-driven, meaning, they're investment banks. They're not really, retail banks. So they're not benefiting from interest rates increasing. Instead, actually, the deal flow that's drying up is what's hurting their earnings. And by the looks of, the pre-statements that we've seen, and based on our evaluations, that most of these banks like JP Morgan, Goldman Sachs, and Bank of America, they're not going to be doing all that well in terms of earnings.
And of course, we've got the Elon Musk Twitter deal, which is quite a fascinating one for me, because in the beginning, Twitter didn't want the deal, but then Elon Musk wanted it, and now he doesn't want it. And now they're kind of forcing him to go through it, at least trying to go through the courts. What does it mean for Twitter's prospects? And perhaps we can even touch on how Twitter fares against its peers in this environment.
Look, when it comes to the actual platform, using Twitter is amazing. But in terms of an investment, as an individual, I wouldn't put my money or clients' monies on something like a Twitter or Snapchat or even Pinterest, because, they don't move the needle in the social media sphere in terms of earnings. The big daddy is still obviously Instagram and Facebook, which are all held by Meta. So we're going to be watching those very closely. I think that share price has re-rated to the downside and brought basically the entire social media sector with them down. because they're sort of the bellwether in social media. But looking at the Twitter deal itself, I mean, I'll leave you with a conspiracy theory here that said, Elon Musk took the opportunity to sell Tesla stock at highs last year, which, we no longer are seeing those highs of $1,000 a share, 1.2. We're around 700 now, to actually crystallize his gains and take some profits and make it seem like he wanted to buy Twitter as a result. But then, backing off the deal and paying a break fee is still cheaper than actually not having that in cash. So I don't know, man. I don't know what's happening in the richest man's brain, and I don't want to find out.
Well, on that note then, you may not want to find out, but we'll definitely be keeping viewers informed, especially with what is happening in the world of Elon Musk, especially as it relates to that Twitter deal. Nonetheless, we've reached the end of this particular interview. We're going to take a quick break, and when we come back, we'll have more news for you, so stay tuned for that.